What if I told you there are three stocks trading for less than $5 right now that analysts are predicting could see massive earnings growth in the coming year? Not just decent growth, not just good growth, but explosive triple-digit percentage growth that could send these stocks soaring. Stick around because the last stock on this list has a projected earnings growth of 125%, and you're not going to want to miss it. Hey everyone, welcome back to Stock Vibe, where we find the best investment opportunities before they explode. If you're new here, we specialize in finding undervalued stocks with serious growth potential. And if you enjoy this kind of content, make sure you hit that subscribe button and turn on notifications so you never miss our next stock pick. Now, before we dive into these three stocks, let me explain why this list is different from what you usually see. We're not just looking at random analyst price targets or throwing darts at a board. We're focusing on something much more concrete and much more powerful: projected earnings growth. And here's why that matters so much. If you've been investing for any length of time, you know that one of the strongest predictors of future stock price movement is earnings growth. When a company starts making more money, when profits start climbing, the stock price typically follows. It's not magic, it's just how the market works. Companies that deliver on earnings expectations get rewarded. Companies that miss get punished. We've seen this play out countless times, especially during the recent earnings season, where companies that didn't beat by enough saw their stocks tank, even though they technically beat estimates. But here's what makes these three stocks so interesting. Analysts have set incredibly high bars for them. They're expecting significant earnings growth. And if these companies deliver, we could see substantial price appreciation from current levels. We're talking about real money-making opportunities here, not just speculation. The kind of opportunities that can seriously boost your portfolio if you time it right. Now, let me be crystal clear about something. When we talk about earnings growth projections, we're not talking about where analysts think the stock price will go. That's a different metric entirely. Price targets usually lag behind earnings projections because analysts want to see the company actually deliver the results before they update their price targets. But the earnings projections, those tell us what analysts believe these companies are capable of achieving. And when we see triple-digit earnings growth expectations, that's when our ears perk up. So these are smaller companies we're looking at today, stocks trading under $5. And I know a lot of you watching love these kinds of picks because there's something special about getting in early on a company before it takes off. The potential for massive gains is just different when you're dealing with stocks at these price levels. A stock at $5 only needs to hit $7.50 to give you a 50% return. That same move on a $100 stock would require it to hit $150. The math just works differently. Let me jump into our first stock. This is a company called Transocean, and the ticker symbol is RIG. Now, full transparency here, the stock is actually trading slightly above $5 as I'm recording this. But here's what caught my attention. In a week where the overall market has been getting absolutely crushed, RIG is up nearly 7%. When you see a stock, especially a smaller stock like this, outperforming while everything else is getting dragged down, that's a signal worth paying attention to. So what does Transocean actually do? They provide offshore contract drilling services for the oil and gas industry. But they're not just drilling anywhere. They specialize in the really difficult stuff, the deepwater drilling operations that other companies struggle with. They've got a specialized fleet designed specifically for these complex deepwater projects. And that specialization gives them an edge in an industry where expertise matters. Now you might be wondering, why is an oil drilling company getting a boost right now? Great question. Oil prices have been slowly climbing higher. And here's the thing about rising oil prices. When oil companies see prices going up, they don't just maximize production from existing wells. They start thinking about exploration. They start looking for new drilling sites, new locations, new opportunities. And that's exactly where a company like Transocean comes in. What we're seeing right now is likely speculation that oil companies are going to ramp up their exploration activities. And if that happens, if these oil companies start actively searching for new drilling locations and bringing in companies to drill in new sites, Transocean is positioned to benefit significantly from that increased activity. But let's talk about something interesting here. Transocean is not a new company. They've been around for a while. So why has the stock stayed so small? Why hasn't it taken off already? The answer comes down to one word: profitability, or more accurately, the lack of it for most of the past year and a half. In their most recent quarter, the one they reported at the end of October, they delivered their first positive adjusted earnings per share in 6 quarters. 6 quarters of negative earnings, and then finally a profitable quarter. Now, this isn't a revenue problem. Revenue has been growing steadily, both compared to previous quarters and year over year. The issue has been converting that revenue into actual profit, but they finally did it last quarter, and analysts are expecting that trend to continue. Here's the really exciting part. Analysts are projecting Transocean to grow earnings by 100% compared to last year. Now, yes, last year's number was negative, but they're expecting the company to not just turn positive, but to turn massively positive. That's a huge swing, and if it happens, if the company delivers on that projection, we could see significant upward movement in the stock price. So what about analyst price targets? Well, here's where it gets interesting. The stock is currently trading slightly above the consensus price target, mainly because it surged so much this week. But BTI Research just increased their price target from $5 to $6 earlier this week. That's a 20% increase in their target. And here's something else to keep in mind. The company reports earnings on February 19th. That's when we're really going to see if this thesis holds up. Typically, what happens around earnings is analysts sharpen their pencils. They wait for the actual results to come in, and then they start revising their estimates based on what they see. If Transocean's earnings results support the main thesis that there's going to be increased drilling activity for the rest of the year, we could start seeing significant upward revisions to price targets across the board. Now, that 100% earnings growth, is that expected to show up in the February 19th earnings report? Not exactly. What investors are going to want to see is positive adjusted earnings per share again. They want to see that number growing from the previous quarter, but more importantly, they want to hear the company's guidance for the full year. They want to hear management confirm that, yes, we're projecting earnings numbers that would support this 100% growth expectation. If the company comes out and says, we're expecting strong activity, we're seeing increased demand, we're optimistic about the rest of the year, that's when you could really see this stock take off. Because right now there's speculation, but when the company confirms it themselves, speculation turns into conviction, and that's when the real money starts flowing in. Before we move to stock number 2, I want to remind you to drop a comment below and let me know what you think about these picks. Are you bullish on oil? Do you think Transocean can deliver? And make sure you're sharing this video with anyone who's interested in finding undervalued growth stocks, because these opportunities don't come around every day. All right, let's move to our second stock. This one is B2 Gold, ticker symbol BTG. If Transocean is a speculative bet on oil prices and oil production, B2 Gold is a speculative bet on gold prices and gold production. This is considered a mid-cap company, but in the mining world, they're classified as a junior miner. They're based in British Columbia, and they have mining operations all over the world. When I say junior miner, I'm talking about a company that's more growth-focused than the major established players like Barrick Gold or Newmont. These junior miners are where you find the explosive growth potential in the precious metal space. They're smaller, they're more nimble, and when gold prices move, they tend to move even more dramatically. Now, I know some people are bearish on gold miners right now. The sector did get ahead of itself a bit when gold hit $3,000 and silver touched $35. Those were big psychological numbers, and traders drove prices up to see if they could hit those targets, and they did. But those parabolic moves usually don't end well for short-term traders trying to catch the wave. Here's my take, though. The fundamental catalysts that have been pushing precious metals higher are still in place. We're seeing limited supply. We're seeing central banks around the world continuing to buy gold, which puts a floor under prices. And there's still uncertainty around the value of the US dollar. Gold and the dollar have an inverse relationship. When the dollar weakens, gold typically strengthens. And guess what? The dollar has been softening recently, and gold prices have started ticking back up. I think there's a strong fundamental case for gold to continue moving higher this year. Maybe not parabolic like we saw earlier, but a steady grind higher. And if that happens, junior miners like B2 Gold are positioned for a massive catch-up trade because mining stocks didn't keep pace with gold prices last year. That gap needs to close. So how much earnings growth are analysts expecting from B2 Gold? We're talking about a 76% increase in earnings. That's massive. And it all comes down to the company being able to efficiently extract gold and convert that into profit. If they can do that while gold prices remain elevated or continue climbing, the profit margins expand significantly. Here's the thing about gold miners. They tend to leverage the movement in gold prices. If gold goes up by 10%, mining stocks often go up by 20 or 30% because of the operating leverage they have. So if we see gold hit $3,000 by the end of the year, which I think is realistic, you could see gold miners outperforming gold itself by a substantial margin. Both stocks are heavily dependent on gold prices staying strong or moving higher. I'm personally bullish on gold for the reasons I mentioned, but I understand others are more cautious. It's definitely a higher risk play, but with risk comes potential reward. And with 76% projected earnings growth, the reward potential here is significant. Now let's get to our third and final stock. And this one has the highest projected earnings growth of all three. We're moving into the biotech sector, and I know many of you love when we cover biotech penny stocks. There's something exciting about the potential in this space. But here's what makes this company different from many biotechs we discuss. This isn't a clinical stage company burning through cash with no revenue. This company actually has drugs on the market. They're generating revenue right now. They're not profitable yet, but they're bringing in real money from real products that real patients are using. That significantly reduces some of the risk you typically see with early-stage biotech companies. The company we're talking about is Ironwood Pharmaceuticals, ticker symbol IRWD. They focus on gastrointestinal diseases. And before you ask, no, this is not a GLP-1 drug company, but it is in a growing area of medical research that's seeing significant investment and interest. Here's what makes Ironwood so interesting right now. They have a drug in phase 3 trials. For those who don't know, phase 3 is the final stage before a company can apply for FDA approval and potentially get the drug to market. Successfully completing phase 3 trials and getting FDA approval can be a massive catalyst for biotech stocks. But wait, it gets better. The company recently increased their revenue projections for the next 12 months by 40%. 40%. That's not a small adjustment. That's a major upward revision. And analysts are taking notice. They're already projecting earnings growth of 125% for this company. Think about that for a second. A company that already has revenue-generating products, that just increased revenue guidance by 40%, and that has analysts expecting earnings to more than double. If they can execute on this, if they can deliver on these projections, we could see substantial price appreciation. The catalyst here is clear. If revenue is going up by that much, and if the company can maintain or improve their operating efficiency, that should flow through to significantly improved earnings. The company does need to execute, there's no guarantee. But the fact that they already have products in the market, that they're already generating revenue, that removes a huge layer of uncertainty compared to most biotech penny stocks. With clinical stage companies, you're betting on whether a drug will work, whether it will get approved, whether it will find a market. With Ironwood, those questions have already been answered for their existing products. Now the question is simply whether they can grow what they've already built and successfully bring new products to market. So there you have it. 3 stocks under $5 with massive projected earnings growth. Transocean with 100% projected earnings growth, riding the wave of potential increased oil exploration. B2 Gold with 76% projected earnings growth, positioned to benefit from higher gold prices. And Ironwood Pharmaceuticals with 125% projected earnings growth, executing on revenue expansion in the biotech space. These are higher risk plays, no question about it. Stocks at these price levels can be volatile. They can move dramatically in both directions. But with that risk comes the potential for outsized returns. These are the kinds of stocks that can double or triple if things go right. And based on what analysts are expecting, things could very well go right. If you found value in this video, make sure you hit that like button and subscribe to Stock Vibe so you don't miss our next analysis. Drop a comment and let me know which of these 3 stocks you find most interesting. Are you leaning toward the oil play with Transocean, the precious metals play with B2 Gold, or the biotech play with Ironwood? I want to hear from you, and please share this video with anyone who's interested in finding undervalued growth stocks. The more people we can help find these opportunities, the better. Remember, we're all in this together, trying to build wealth and secure our financial futures. Thanks for watching Stock Vibe, and I'll see you in the next video where we'll be hunting for more hidden gems.